Welcome back to Investing Talk Podcast.
Today, we are counting down the top 5 stocks to buy right now based on our latest research.
This is a big one. Before we get to our first pick, be sure to subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave in the comments below.
All right, let's start the countdown. What's the first company on our list?
First up is Artello Biosciences. The reason it's standing out is, well, it's a clinical stage biotech focused squarely on the lipid signaling pathway.
Okay, clinical stage. So 0 revenue right now, I assume.
Exactly. 0 revenue. But what's really interesting here is the financial side.
Because that's usually the worry with these companies, the cash burn.
Right. But Artello maintains very low debt. Get this. Their debt-equity ratio is negative 56.3%.
Negative. Wow. Okay, so they're holding more cash than liabilities.
Precisely. Gives them a lot of financial flexibility, which is crucial.
Absolutely critical for funding those trials without constantly needing more cash. What's the main drug candidate?
That would be ART 27.13. It's a ghoul cannabinoid agonist.
Okay, and the target indication?
It's in phase 1b/2a trials for cancer-related anorexia. A really serious unmet need.
And the recent data sparked some interest.
Yeah, big time. The interim phase 2 results were quite striking, showed meaningful efficacy.
How so?
Well, patients treated with the drug gained, on average, over 6% body weight.
Okay, that sounds positive. What about the control group?
The placebo group actually lost weight, about 5%.
Wow, so like an 11-point swing between the two groups?
Exactly. That's a strong signal the drug might really be working.
No wonder analysts are optimistic then. I saw a strong buy consensus.
Yep, and some really aggressive price targets too, up to, I think, $33.84.
Whoa. That's just massive upside, but obviously hinges on hitting those clinical milestones.
Absolutely. It's a high-risk play, no doubt. But that financial cushion, that negative DE, it does de-risk it somewhat, gives the science a better shot.
Okay, interesting start. A high-potential biotech. Moving on, my pick for the next one is Castellum.
Oh, Castellum. Different beast altogether.
Totally different. This one is all about cybersecurity and IT solutions, but specifically for federal agencies.
Right, that government focus is key. It gives them a strong base.
It does, and the big news here is profitability. Q3 2025 marked their first ever GAAP net profit.
First ever. Okay, that's a major milestone. How much?
It was $0.4 million in operating profit, and this came after 3 straight quarters of organic revenue growth.
Nice. So not just growing, but growing efficiently now. What was Q3 revenue?
Hit $14.6 million, so solid growth turning into actual profit.
And what about their balance sheet? Government work often requires financial stability.
Yeah, and they've been quite aggressive in deleveraging, actually, strengthening the balance sheet.
Okay.
They're holding a record cash balance, $17.8 million.
And that's debt.
Compared to only $2.4 million in total debt. Very healthy ratio.
That definitely helps when bidding for those big government contracts. Any major wins recently?
Huge one. Their subsidiary, SSI, landed a massive contract.
Oh, yeah.
Yeah, $66.2 million. It's a 5-year deal for cyber support.
$66 million over 5 years. That provides some serious long-term revenue visibility.
Exactly. Really solidifies their position. Makes them look much more stable.
Okay, that's a strong execution story.
Yeah.
So from federal IT to global finance infrastructure. My third pick is MSCI.
MSCI. A giant in its field.
Absolutely. You could argue they have one of the strongest competitive moats out there. Leading global provider of equity indexes.
Basically essential plumbing for institutional investors, right? ETFs, mutual funds.
Exactly. Once a fund tracks an MSCI index, it's very, very sticky. Switching is costly and complex.
Gives them that predictable recurring revenue stream. How are the financials looking?
Really solid. They reported 9.1% year-over-year revenue growth, which is strong. But the really eye-popping number is the margin.
Always is with MSCI.
Yeah. A 39.4% net margin for the first 9 months ending September 2025. Just incredible efficiency.
Almost 40 cents of every dollar drops to the bottom line. That's software-level profitability.
It really is. And that strong free cash flow supports shareholder returns, too.
Right. They have a decent dividend, don't they?
Yeah. $7.20 per share currently. Yields about 1.25%.
Nice. So stability, moat, profitability, dividends. What's the near-term driver here?
The big one happening very soon is the implementation of their major November index review.
Yes, the rebalancing. That's happening November 24th, right?
Correct. And while it sounds routine for MSCI, it forces massive portfolio adjustments globally.
Because all the funds tracking those indexes have to buy and sell based on the changes MSCI makes.
Exactly. billions of dollars moving,
Hmm.
and that activity drives higher licensing fees and data usage for MSCI. Kind of a guaranteed bump in activity.
Got it. Okay, let's shift gears dramatically now. My fourth pick takes us into the EV space, NEO.
NEO. Okay, high growth, lots of volatility there usually. What's the angle right now?
Well, it's really about operational strength meeting potentially explosive market technicals.
Let's start with the operational side. Deliveries have been strong.
Very strong. They just set a new monthly record in October. Delivered 40,397 vehicles.
Wow, over 40,000. What's the year-over-year growth on that?
Get this, 92.6%.
92%. Okay, that's huge growth. Shows the demand is definitely there.
Absolutely. And it's not just volume. They're getting recognition for their tech, too.
Like what?
Their redesigned ES8 SUV just won an award, the China Heart 2025 Award, specifically for its 900-volt system.
So underlining their tech leadership helps justify premium pricing, I guess.
Exactly. Reinforces that product appeal. Now, about those market technicals you mentioned.
Right, you said explosive. What's going on there?
Okay, so you've got very high retail ownership, about 55.8% of the float.
Okay, lots of individual investors.
And combined with that, you have a pretty large short interest. The days to cover is sitting around 4.04 days.
4 days to cover. Explain what that means again.
Means if all the short sellers decided to buy back their shares to close their positions, it would take over 4 full trading days based on average volume.
Okay, so if the price starts moving up, especially past key resistance levels, like around $8.02.
Exactly. Those shorts might be forced to buy back quickly to limit losses, creating a rush of buying pressure. A potential short squeeze.
Right, so high operational growth plus a potential technical catalyst. What's the key risk or the next big check-in point?
It's definitely the upcoming Q3 earnings release. That's scheduled for December 15th.
Everyone will be watching.
Margins, absolutely crucial. Need to see if those record deliveries are actually improving profitability, not just costing more money. That's the make or break moment for the current narrative.
Got it. A lot riding on that earnings call. Okay, that brings us to our fifth and final stock. A very different kind of company again. I'm looking at Pfizer.
Ah, the pharma giant. Feels more like a value play, perhaps.
Exactly. It's really a value proposition right now, maybe with an activist kicker.
Okay, lay out the value case. Treating cheap.
Very cheap relative to its scale. The forward PE, price-to-earnings ratio, is just 8.1.
8.1. That's definitely below the industry average for big pharma.
Way below, especially for a company that pulled in, $62.79 billion in revenue over the last 12 months. Huge scale.
But often when a giant trades that cheap, there are concerns. Patent cliffs, maybe litigation.
Sure, there are headwinds. They're navigating patent challenges and some legal stuff, definitely. That's partly why it's cheap.
And what about the dividend? It's quite high, isn't it? Close to 7%.
Yeah, the yield is nearly 7%, currently $1.72 per share annually.
That's very attractive for income investors, but sometimes a super high yield can be a warning sign, a signal the market expects a cut.
That's the debate. But our research suggests the dividend looks sustainable for now. It provides a strong sort of defensive cushion while the company works through its issues. You get paid to wait, essentially.
Okay, and you mentioned an activist kicker.
Yes. Big news recently. Starboard Value, a well-known activist investor, disclosed a large stake, about $1 billion worth.
$1 billion. Okay. Starboard doesn't usually make passive investments. They expect change.
Exactly. It signals strong confidence that there's value to be unlocked here, likely through, streamlining operations, better cost controls, maybe strategic moves, puts pressure on management.
So the activist angle focuses on efficiency. What about the long-term growth from new drugs?
That's the other side of the coin. Even with patent expirations on older drugs, Pfizer still has a robust late-stage pipeline. Oncology, immunology, vaccines. It's still strong.
So the thesis is, buy it cheap, collect a solid dividend, benefit from activist pressure on costs, and wait for the pipeline to deliver future growth.
That's pretty much it in a nutshell. Discounted cash flow machine with catalysts. So to recap, our 5 stocks to watch are Artello Biosciences, Castellum, MSCI, NEO, and Pfizer.
A solid list. Covers a lot of ground, from high-risk biotech to global finance and value pharma. As always, do your own research before making any investment decisions. Thanks for tuning in.